without further ado, good afternoon and welcome to the later hours of TheoTRADE. As you know, I am Professor Jeff Bierman. I'm broadcasting live from Chicago, and today is Tuesday. It is October 1st. It is 2024. Good afternoon, TheoTRADE members. Now, I cannot say that I saw this coming. Like, I don't know what the trigger was going to be. I don't know what the catalyst was. I don't even care what the catalyst was. All I said is that when the quarter is over, expect a free fall for a few weeks. Expect a corrective move from 5 to 10%. Whether it's going to happen in 1 day, 10 days, 20, it's all up in the air because I don't have a clock in my head. All I do is I follow my models. And my models tell me that, do we have upside? Yeah, but the downside far outweighs the upside. And as much fun as Dawn pokes at me, I was right every day for the month saying, listen, it's all machine driven. Wait until the new market opens, which is today, and let's see what happens. Now, I thought we were going to open up higher today just to put money to work and then reverse. We reversed a lot quicker, evidently because of, the war drums are coming out here. Now, I did not see that coming at all, but it doesn't matter. I don't wait for events to happen. I just take my trades based upon my model and I go with it. So with that said, okay, I'm going to do a program today and I want to do 10 minutes of color. But before I do that, here's the program itself. Now, there's many ways I could have taken this program. I could have called it fundamentals. I could have called it trends. I could have called it momentum. None of the above. To me, I'm calling this program, okay, categorically volatility. And the thing is, with high frequency trading, there really isn't volatility. Like, that's the counterintuitive logic of this. Okay, think about this. HFT, which is the term for high frequency trading, you would have thought like, oh, it increases volatility. It does not. It actually does the opposite. So without further ado, the program today is titled, and again, I'm going to lay it out there just for kicks here. The category is volatility. And it's really a lack of. It's a paradox here. Okay, it's called The Fast and the Furious, ode to, like, that franchise with Paul Walker and The Rock and the bald gentleman who likes to flex his muscles all the time. It's called the systemic, and the key word here is systemic risks of algorithmic high frequency trading. So I'm going to move it to the next line. High frequency trading. And the people in the industry don't call it high frequency trading. They call it HFT. It's the acronym for high frequency trading. I will promise you, I will spend 2 days, okay, separating, curating, and distilling differences in what you think are occurring, okay? Because there's different types of high frequency trading. There's different types of algo trading. And I want to pinpoint exactly what I'm talking about. If you watch the market day by day by day, and you're seeing these VWAP sprays, and you're seeing quick bursts of moves or lack thereof, it's usually high frequency trading. You need to learn more about it. You need to get educated. And I'm here to fill that gap because I'm going to do it. I've got some graphics. Give me a chance to unpack this. But I want to talk about the market just as it were today, because I know a lot of people are like jumping around. This is the beginning of the end. Stop it. Stop. You're killing me. Okay. Again, many head fakes, there's all kinds of false positives here, false negatives, pardon me. All right. The first thing I want to point out is this. Okay. Put aside your bias, as Don would say. Like, get beyond that. Get beyond the optics. Get beyond the news and the macro data. I don't care, okay? Get beyond it. Take a look at what you're seeing. Have we broken the curated channel? Calm down. We haven't broken nothing. Nothing's happened. Basically, we went down 1.5%, and we might even close unchanged for all you know. I have no idea. We also are supported heavily at about 56, 67, right about there. You're not even close to that number. Like, you Chicken Littles, you bears, take it down a notch. We're not close yet. You got to give it time to marinate. Okay. That's the good news. Want to know what the bad news is? Here's the bad news, bears. You have a lot of air underneath this market. Too much air for my comfortability. See that? If we can intersect across 5,700 and you've got 73 points to protect you, 73 points to protect you, okay? You got to get the Stoke, okay, and pardon me, the RSI below 50. Not. All you've done is you've taken 5% off it. It's nothing. Oh, you perma bears, control yourself. We haven't even done anything yet. The MACD hasn't even crossed over either. The lip curl hasn't even started. That's the bad news. What's the good news? The good news is once it starts, it could be a nice 250-point meltdown. But again, until it happens, I pump the brakes because seeing is believing. I'm in Corey's camp. You got to see it or it ain't real. I don't see it, so it ain't real to me. That could bounce off there, go back up to 6,000 and screw all the bears. I don't know. I need confirmation or I'm not biting on this crap sandwich. I'm not. That is starting to move in the direction. They're all lined up beautifully, but you need a fat, disgusting Maribozu that takes that out and brings us down underneath a 50 RSI. Until then, I reserve the right to say nothing has occurred even today. All we've done is we've gone right back to where we were a week ago. So the bulls are still in control, sad as it may sound. And here's something even more disturbing. And I'm long-term bearish on this market, so I'm holding my water here. But here's what I'm telling you. You want to see something interesting? Has the monthly, the 5-year monthly, monthly, let me get it to you. Has the 5-year monthly even shred a move? Has it busted a move? Has that curled over? I didn't think so. Has the Stoke moved down? I didn't think so. Has it broken underneath the 70 threshold? I didn't think so. People, I have given up completely on the dailies. I only use the dailies for quick swing trades. But if you're a long-term position trader and you want those 5-week trades, you got to move to a monthly. That monthly is still intact. So what you're seeing here today is real. We did get dinged, but the advanced decline is not that negative. It should have been a lot worse. If it were that bad, it would have been a 90-10. What are you seeing? You're basically seeing a 2 to 3, 2 up for every 3 down. It's nothing. I call this a waste of a day. It's literally, this is a complete waste of a day if you're a bear. It's a waste. All I did was I took some gains on some of my short positions in stock like Roblox because I got in at 47. I got out around 43, just like 100 shares. I just scalped and curated and took some gains on the short side. Long side, it's doing all right. But again, I am not sold like a lot of people. I think people here need to really calm down. Nothing has really happened yet, okay, other than we took out 40 points. And all we did was we gave back last week's move, which was just manipulated by algorithms, pushing it higher. Until this gets through 5,700 and these confirm, I'm not biting on it. We got a head fake here, and we rallied all the way back and squeezed the shorts for 200. I'm seeing is believing. I'm not biting on this at all. Here's another thing. If I jump to the DMI, okay, all I'm seeing is a mild bearish divergence, but we're still above the 20-day moving average. That's not bearish. That's bullish. Oh, by the way, the DI plus is still above the DI minus. That's not bearish. That's bullish. And the MACD histogram, that's also bullish. All of them are bullish. The only thing that calls this into question is the ADX, which is a 20 handle, which tells you the market's basically non-trending. Well, I know it's non-trending because it's gone sideways for 10 straight days. So I don't need the ADX to feed me that information. This is just a holding pattern until the market makes up what it wants to do. We're at an 18 VIX. Get me to a 25 and it's game on. Now, for those people who ask, and you have a right to ask, like, what is it he's trading? I'll be happy to tell you. Okay, let me tell you what I took off today. If anybody's interested, okay, I took it off. Okay, I got into Bud at 62. My target price was 67, so I got out. I just set a 67. It tripped. It was gone. I'm out. I'm out of the trade. There it is. Okay, got in over here on the breakout. Got out there. This is what I do. I get in. I get out. I set my targets and I move on. overbought. I like to sell overbought. It's just my thing. I sell overbought and I buy oversold. I don't short oversold or buy overbought. I never do. That's why I don't suffer like this. But I got out of that. Okay. Was in Morgan Stanley at 98. 98. I got it on the breakout. I got out today. I put an alert out, took it out at 104 and quarter. I'm out. I'm out of it completely. I just took basically the stock, 100 shares, and I rolled in and rolled out, caught myself almost, but not quite $6. All I do is I just follow the strength of the RSI and the MACD, and I don't fight the indicators. Those are my two call out trades. My other long trade, which is kind of getting tagged, and I'm not happy about it, is C. That's one of them, but that's holding okay. I've been down. I'm down here on the breakout. My target price is 38.5, so I'm still hanging tough with this. I also own Archer Daniel Midland at ADM at 58. Okay, got it over here on the breakout. Where is it? Over here? Okay, still hanging tough. Wish I would have sold it yesterday, didn't, but it's up 18 cents. I'll take it. People, the stock's trading at a ridiculous valuation. I look at fundamentals, they matter. 11 times earnings is just stupid. It should be more like 15 to 20. So those are some of my long positions. And the one that's just getting absolutely slammed today is Baxter. There's nothing I could have done. It was on its way up. Yesterday, Baxter said that they had a plant that was shut down in an area of North Carolina that suffered tremendous Hurricane Helene damage. And this is just follow through of momentum selling. See how the hockey stick pivot goes down? That's unbuyable. Did any of you buy this? You obviously don't know how my system. You don't buy on the way down. It's on the way up. This is totally unbuyable. What am I going to do about this? Nothing. There's nothing I can do. All I can do is step in and sell a call or buy a put. But I don't like to make the trade on a down day because it means I'm going to get a bad, stupid price and I'm going to nullify my gain. All I want is for this to pop a point or two and I'll immediately start selling a call against it. I just got 75 shares. Yeah, I'm getting hurt. It's not feeling good. But again, what momentum selling does is it pushes crap over the edge. Notice here how it threatened to 37.5, took it out. Again, until the market pushes its Humpty Dumpty, you got to go over the wall. You can't just tag the wall. You got to go through it or it's a head fake to me. This is the real deal. I'm stuck with this. I don't really want to sell it on the way down, but if it does bounce from an oversold condition, I will lighten up. As far as my short trades, when people ask, listen, I put this on yesterday at 175 and change. It came down today to about 170. So I got out of the 50 shares I took short. But the problem is I'm in a call spread, which I haven't gained any traction on. Why have I gained no traction? It's obvious because the MACD is not underneath the signal line. Every time something collapses and bounces, it's because it's not under the signal line. You all have to learn this one way or another. It's not going to go down unless it breaks the signal line. That's why the E-mini's rallying. It never broke the signal line. Look at the E-mini. It's not broken the signal line. If it breaks the signal line, you're going to get a 150-point down day, no doubt. It's got to break it. If it doesn't, the dippers are going to come in every time. So I looked at RCL and said, dang, couldn't get any traction on my option. I got no traction on it, even. But because I hit 50 shares yesterday at the close, I was able to snipe my way out of that at 171. So I basically got 250 bucks off the 50 shares, but I'm pissed off because I got nothing out of the option. Didn't do anything. What's my other trade? Okay. I'm short Roblox. Okay. I took off the stock trade, but I'm still sitting on a couple of call spreads from when I nailed it up here. I'm just sitting on it. I'm not doing anything. Look, it broke underneath the 50. So I just okay, I'll take some risk off at the support. I'll let the options play themselves out. So I'm in Roblox short. Everybody in the world knows I'm short Coke, and I just added more. I just don't care. In fact, as far as I'm concerned, I will own this company on the short side. This thing has got to blow one way or another. It's the biggest bubble in the entire market as far as I'm concerned. I got in at 72, 60. I just threw in 50, covered at 70, 180. I'm still short 100, so I'm just going to let this play. Again, until this takes out 50, I can't make money on this. But I can make money playing a Corey Rosenblum Blake game of scalping. It rallies up. I can track it. I was at my office. I saw it tagged up here, got overbought, hit it short, wrote it down, covered. But I'm still going to stay in my 100 trades. This I'm going to take to my grave. I'm not coming off this hell or high water. I just don't care. I'm like Don. It gets to a point where I just stop caring. I'm aggravated, but I just don't care. Because I'm not going to, this thing has to blow through. They're just hiding in this because it's Coke in a defensive posture. The last one I'm short here is, everybody knows I'm short Uber. Okay, that's it. I'm short Uber. How much am I up? I'm barely up like 50 cents. That's it. I'm going to wait. It's not going to break down. The reason why it's not going to break down is because it has to get through that signal line. If it gets through the signal line and gets through the 50, Uber's going to crash and burn. It'll be like a complete utter auto disaster. I know it. They know it. It just, I have to wait until the technicals line up. When that happens, I'm good to go. So I'm playing both sides of the market today. I'm just a little bit like flustered because I should have taken out Baxter yesterday and I didn't, but that's that. And I got my eyeball a lot of other crap. I'm just not one to commit to it. I'm with Tony. I'm not one to buy this, but okay, I see this market rallying up today big time. As a matter of fact, I wouldn't be surprised to see the market completely close flat today. And people like, he's smoking dope. Really? It's almost flat now. You're not getting the market down until you break underneath that key level. I keep telling all of you this. You've been head faked for a month. You got to learn at some point. All right, moving upward and onward. Let's talk about HFT, high frequency trading. So let's get to it. Technicals, we don't need no stinking technicals today. Get rid of all that crap. We don't need it. We're going to talk about, okay, volatility. And the key here is it's a paradox. Paradox, like pleasing plague, like dry water, okay? The idea is they're opposites. I'm going to tell you right now, you need to learn about high frequency trading and understand why did the market rally 35? Why is this happening? I'll explain to you over 2 days. It's all about HFT, high frequency trading. So I got a lot of stuff to unpack here. First things first is people are going to ask me, what the heck do you mean by high frequency trading? Is that just algorithmic trading? Well, algorithmic trading is the blanket statement. Machines, yes, but there's subsets that fall underneath the machines. And there's this type of trading and that strategy and this strategy. Okay, HFT, yes, it's algorithmic, but it's like a subset of algorithmic trading. Don't confuse it with arbitrage. Don't confuse it with event. It's different. So let me bring it to you, okay, piece by piece by piece by piece. Okay, what the hell is high frequency trading? All right, so what is algorithmic high frequency trading? Okay, first off, algorithmic trading or algo trading refers to the use of computer algorithms or programs, basically a set of rules or instructions to make a computer perform a given task for trading large blocks of stocks or other financial assets while minimizing the impact of such trades. That's a big mouthful. But what most people don't realize is, and this is the part I want to get through your head, is this, okay? Yes, it's fast, but it's fast for a reason. To minimize impact, provide liquidity, kill vol, manipulate. That's what they're designed to do. And they do it in a speed that's so fast, you can't see it and you never will. It's like 1/1,000,000th of a second. And they're firing off like 10,000 trades per second to get this done. So let me continue on so you can read some of the stuff on here. All right. So algorithmic trading, what does it involve? It involves placing trades, multiple trades, sometimes thousands at a second by one entity on defined criteria and carving up these trades into smaller lots so that the price of the stock or asset isn't impacted significantly. They want to kill volatility. They want to kill slippage. Why? Because it removes risk. It mitigates risk so they can almost guarantee themselves money if they can control the direction. That's the point. The benefits of algorithmic trading are obvious. It ensures, quote, and this is the part that Don likes, and I agree because I'm not fighting with Kaufman on this one. It ensures the, quote, best execution practices of trades because it minimizes the human element and it can be used to trade multiple markets and assets far more efficiently than a flesh and bones trader could hope to do so. That's a fact. But I digress. Let me continue on further. So let me give you the takeaways you're learning here. Algorithmic trading refers to the use of computer algorithms for trading large blocks of stock or other financial assets while minimizing the impact across the market. So what they want to do is they want to get the trades off fast and furious, but they want to do it to effect so it does not upset the apple cart or create systematic volatility around the market. I want to throw that out there. Algorithmic trading involves placing trades on defined criteria, okay, and carving up these trades into smaller lots so the price of the asset isn't impacted significantly, okay? The primary benefits are best execution and more efficiency and better liquidity. As the term implies, high-frequency trading involves placing thousands of orders at blindingly fast speeds. While algorithmic trading and high-frequency trading have arguably improved the market liquidity and asset pricing consistency, their use has given rise to certain collateral risks, primarily its ability to amplify systemic risk, which I'm going to educate you all today. I'm going to turn you in. I'm going to literally put you front and center inside as if you were inside one of my classes at Loyola, and I'm going to force your hand to become an academic, whether you like it or you don't like it. Okay. So again, you look at the definitions up here: numerous trades in milliseconds, short-lived profit opportunities, powerful computers that cost millions and millions of dollars. Okay, it's so like prohibitive. The entry to get in is almost ridiculous. Key features: high speeds, high turnover rates, high order to trade ratios, sophisticated technology. Okay, profitability. Well, it's profitable for firms that are very well equipped and highly capitalized. Profits are from tiny gains, from minutiae. So they pile it up. They're hitting not singles, they're hitting bunt singles 1,000,000 times a day is what they're doing. And it's not suitable for retail traders because you don't have the resource, you have resource limitations. So don't go down that path. This is not to insult you. It's to educate you and bring you up to speed. If you're losing money and you're directionally biased, it's usually because you're on the wrong side of an HFT box that's ripping you apart. And you got to stop trading against it, because they're not going to stop pressing or leaning in that direction. Because if it ain't broke, they ain't going to fix it. I'm going to warn you of this. So HFT, or high frequency trading, takes algorithmic trading to a different level altogether. Okay. Think of it this way. Think of algo trading as algos trading. Think of it as algos on steroids. That's the way of saying it. As the term implies, high-frequency trading places thousands of trades at blindingly fast speeds. What's the goal? Well, the goal is to make tiny profits on each trade, often by capitalizing on price discrepancies for the same stock or assets in different markets, which is a form of statistical arbitrage. HFT is diametrically opposite, from traditional long-term buy and hold investing, since the arbitrage and market-making activities that are HFT's bread and butter generally occur within a small time window before the price discrepancies or mismatches disappear. Algorithmic or HFT trading have become an integral part of the financial markets due to the convergence of several factors. These include the growing role of technology in present-day markets, the increasing complexity of financial instruments and products, and the ceaseless drive towards greater efficiency in trade execution and lower transaction costs. So while algorithmic trading and HFT arguably have improved market liquidity and asset pricing consistency, okay, their growing use has given rise to certain risks that simply cannot be ignored. Last thing I want to throw up at this graphic before I remove it and change it, okay? How it works. There are many, and I mean many, strategies behind HFT. So don't just think it's like, it's a scalping strategy to ruin me. It's not. They're not trying to ruin you. They're just trying to force you to join them. You can't beat them, join them, right? There's market timing, market making, which is liquidity providing. There's event arbitrage, which is predictable market responses, such as today. When you saw the market drop 60 points in 5 minutes, 50, that was an event arbitrage situation based around HFT. You can't react fast enough to it. You had to be in that trade before it happened and got caught that wave down, where you were probably at the end wave of it. Then there's index arbitraging, or exploiting index tracking, where they're mispricing the weights in the index. Or there's statistical arbitrage, which creates price discrepancies between one market and another, crossed markets, bid-offer spreads. And then there's latency arbitrage, which is like, latency simply means it's a descriptive word for how fast an order is entered in the market, filled, and then that fill post or notification comes back at you. Latency is a turnaround process of order entry, order fill, order notified. That's what it's about. So there's latency arbitrage and how long it takes an order to actually get filled and then circle back to the actual individual entity who entered that trade. Okay, it's called turnaround time or latency. Just want to throw that out there. Okay, let me continue on further. All right, so I want to get down. I should have bought that stock. I'm just like looking back here. Didn't do it, but life goes on. I'll probably have a shot before I leave today, before I go pick up my kid. Yeah, I'm pretty bummed that Uber turned around. I'm down $66 today, which is not bad in my long account, but that Uber bugs me. It's just not going. I've got to wait on it. Okay. The biggest risk around HFT is what's known as the amplification of systemic risk. Okay. And there's definitely a confusion. I have students who miss this. At least half the students in my class miss this on the exam. So don't feel bad if you miss it yourself. Okay. Biggest risk of HFT. Okay. The amplification of systemic. I want to like put it in bold letters. Systemic risk. So let me spell this out for you for the next 15 to 20 minutes so you do not misconstrue what this means, because a lot of people, even professionals, okay, fail their final exams for licenses because they just don't even understand what this means. Okay, there are 3 types of risk that are embedded or introduced in the market every day. 3. There's what's known as systemic risk, systemic. Then there's systematic, not systemic, systematic. And then there's what's called non-systematic risk. So let me get into the non-systematic risk first, then the systematic, and then we'll move to systemic. You need to pyramid up. I need to elevate your game to understand that if you like HFT, I like it because I'm a dipper. You're going to hate it when there ain't no dips. You're going to wish that the federal government and Congress, you're going to wish they ban HFT. You're going to say, get really like Leon Cooperman during the COVID. They need to curb these things. Yeah, Leon, it made you a billionaire, guy. Billionaire on the long side. But on the short side, it can bankrupt you at the same time. So let's get down to brass tacks and let's talk about this. What exactly is systematic risk? Okay, here's what it is. Remember, this is not systemic. It's systematic. Different. So systematic risk is risk that is built into the market, but it's not structural. And people are like, well, how can that be? It's not structural. Systematic risk is also known as non-diversifiable risk or market risk. It's fluctuations in security that due to macro normal factors. It could be political, it could be social, it could be economic. But the idea here is things like interest rate risk, inflation risk, the Fed, okay, all of those. The Fed is a form of systematic risk, and it impacts high frequency trading to a degree. You're like, do tell. I am here to tell. The Fed impacts interest rate risk because they're like, cutting rates and they're raising rates. Uncertainty around interest rates creates embedded risk that never goes away. It's never, you cannot diversify it away. Hence the word non-diversifiable. You cannot mitigate it. You cannot eliminate it. Okay. You can't do anything to it. It's built into the system forever. It's a part of the business. It's what they call market risk. It's anything that's macro driven at a macroeconomic level that trickles down to the market and drives prices up or down based upon macro factors. So there's market risk, inflation risk, interest rate risk. They all fall under that umbrella of systematic risk. On the other side of that, there's non-systematic risk or unsystematic risk or diversifiable risk. What does that mean? It means it's risk that you can actually diversify away. You can actually mitigate that risk. You can't eliminate it fully, but you can mitigate it to asymptotic. So most of it is gone. So the risk factors tend to be what's called indigenous, not exogenous, but endogenous, or rather indigenous to the company itself. So for instance, unsystematic risk would be like, Apple can't meet the demand. That's a business risk. Oh my God, Boeing is looking for more funding because it's got a capital structure problem. That's a financial risk. That impacts Boeing. But Boeing is not the market. Boeing is Boeing. Boeing is a constituent in the market that drives the market up and down to a degree, but a very small influence on it compared to, let's say, a NVIDIA or a Microsoft or an Apple. Nevertheless, it's what known as microeconomic factors that drive risk. That's the difference between the two of them. If you add systematic risk plus unsystematic risk, you get total risk. If you isolate the two of them and you look at systematic risk and you go onto the thinkorswim platform and you're like, I'm going to go look at NVIDIA. I love NVIDIA, okay? If you go over here in the corner, NVIDIA's got a beta. See that beta on NVIDIA? That's systematic risk. It's correlated risk to the market movement. 1.6 means it's 60% greater risk on a relative basis to the market overall. If the market jumps 1%, that stock on average is likely to jump about 70% more than the market, meaning it'll jump close to 2% versus the market's 1%. On the downside, if the market drops 1%, that is likely also to drop 2%, so you'll suffer twice the damage. That's the difference. That's the major primary difference, okay, between systematic risk and non-systematic risk. Non-systematic risk, you cannot get out of the market. It's built in. Systematic risk, not diversifiable, or you can actually get rid of it. Now, let me jump back on this for one more thing. One more thing I want to throw out about the two of them before I educate you on systemic risk, okay? So here are like what I call like a bifurcated spreadsheet or table that highlights the differences between the two of them, their impact, the nature factors, etc. This is very good stuff. So again, it sort of cuts through and clarifies what I want to drive. There's a large number of securities associated with the entire market. That's systematic, okay? Unsystematic means it's restricted to one security or one industry, okay? The nature, you cannot control systematic risk. You cannot minimize it, or you cannot avoid, it cannot be avoided by any business's management. Unsystematic can be controlled, it can be minimized, or actually can be avoided altogether. Big difference. What are the factors? Well, they're external macro factors that are geopolitical, economic, and sociological that drive it every day. So what you're seeing today with the markets down 32, whatever, it's driven by war. It's a geopolitical event. That's a systematic risk that you could not mitigate against, but you could individually mitigate against by using individual stocks to mitigate against that risk. That's what I do. I use unsystematic risk to fight off systematic risk. That's how I trade, okay? Then there's internal factors or micro factors. That would fall under the unsystematic line. Over here, how do you get protection? Well, it's asset allocation, okay? Allocation of assets. Here, it's just diversification of stocks among many sectors. It's different. This one cannot be avoided. This one can be avoided and eventually resolved. The types of systematic risks are, and Blake does this beautifully, it could be currency exposure, purchasing power risk, the dollar, interest rate risk, general market risk overall, okay? And over here, it's like business-specific risk and financial risk. So I just want to kind of like bring that to light, clarify it, and say, look, there's all kinds of stuff that goes in the market all the time. It's just a question of how you kind of react to it and how you adjust to it. Now, back it up the truck here, and let's talk about systemic risk, which is the biggest problem with HFTs. You have to understand systematic risk, and you have to understand non-systematic risk to have an appreciation or a grasp of systemic risk. So here's what systemic risk is. Do any of you out there in TheoTRADE chat, any of you, and I suppose all of you do, have a margin account? Then you're at the mercy of systemic risk. Systemic risk is a fancy word for leverage, as in financial leverage, as in structure, as in trigger event, as in, let's say something like ripple effect, as in like, what do you say? Like something that triggers something. That's exactly what it is. So let me get into exactly kind of what it is. And as an example, one of the biggest, if not the biggest risk of HFT is the one it poses to the financial system, the entire system, not the market, but the system as we know, as an existential, its existence, it's existential, okay? A July 2011 report by the International Organization of Securities Commission, the IOSCO, okay, technical committee noted that because of the strong interlinkages between financial markets, such as those in the US, algorithms operating across markets can transmit shocks rapidly from one market to the next. So if there was a time that I'm going to bring you up to speed and wake you up and you shake all you perma bulls out of this, what's going to undo you is not market risk. That's not going to blow your account out, nor will non-systematic risk. In the long run, you'll survive. What's going to take you down and keep you in a bear market potentially for years is that systemic risk. It's the nature of the system itself, where people get completely disconnected from not just fundamentals. They get disconnected from the structure and how the system itself works. It's kind of like Terminator. You build the machines, but the machines turn around and just try to destroy you. It's like genocide of the human race here is what happens. The idea here is algorithms can actually trigger one another like a domino effect and completely destroy markets in a matter of seconds. They can do it. And if you think there's a trigger out there to back it up, okay, to like save it, that's nonsense. You can shut the markets down all you want, but eventually you got to open them up a few days later or a few weeks later. And when you open it up, you know what's going to happen. Chaos is going to ensue because nobody knows how to price anything. There's too much liquidations. There's too many margin calls. There's too many redemptions. There's too much panic. Everybody wants out at the same time, like yelling fire in a crowded theater. Welcome to systemic risk. It's the risk in the market of a Pascal's triangle. It feeds on itself in a basically like a pyramid and spreads downward like a fire or metastasizes like cancer and destroys the system itself because they keep firing off order flow that forces a sell. Even if the asset is worth $100 more, it won't matter. Selling begets selling, begets selling, begets selling. Again, there is systemic risk to the upside. We saw it yesterday where the programmed algos came in, started just barfing up order flow. There's barfing in order flow, chasing everything in a 52-week high. You numbnuts, money managers, they put a program in there. That's part of systemic risk. It's not about fundamentals. It's not about markets. It's about greed and about them understanding how gamma squeezes work within the greater operating system of the market structure, driving it up. That's what amplification of systemic risk is. So let me take you back to an important day in our lives that I'll never forget. Don will never forget. Nobody ever forgets. Rago, none of us, Blake, Corey, Brandon. I remember it like it was yesterday because I was on my honeymoon. Okay, not my honeymoon. I was getting engaged with my wife, and I was in Charleston, South Carolina on a beach when I got the text from thinkorswim that I had to fly back because we have a problem. Problem was flash crash. It was in May of 2010. Here's a prime example. The flash crash refers to the 5% to 6% plunge and rebound in major US equity indices within the span of a few minutes. I didn't say a few hours. I didn't say a few days or weeks. It was within minutes. The whole system came undone. It was on an afternoon of May 6th, 2010. I told you it was like yesterday. Remember it? Like I have a pinpoint memory. I have an eidetic memory of exactly where I was sitting, what beach I was on in Charleston, okay, just laying about with my friends and family, watching this, like look at my stuff. I saw Procter & Gamble was down 90%, was priced at $4 a share, down from like 90. And I was like, kept flicking my thinkorswim app. I thought it was broken. It was actually $4. That's what I'm talking about, systemic risk. So at that point, there was a 1,000-point drop on an intraday basis in a matter of seconds, which at that time was the largest point drop on record. So it makes COVID, until COVID came along, that was the record. As the IOSCO report notes, numerous stocks and ETFs, exchange traded funds, they went haywire that day, tumbling between 5 and 15% before recovering most of their losses. Over 20,000 trades in 300 securities were done at prices as much as 60% away from the market, away from their values, okay? Mere moments earlier, with some trades executed at absurd prices. I told you, I remember like Procter & Gamble, I remember Google, they were mispriced for like 200 points. I couldn't believe it. From as low as 1 penny to as high as $100,000. So the speed at which most of these high frequency trades takes place means one errant or faulty algorithm, okay, can rack up millions in losses in a matter of seconds. I like algos. Don loves them. Hate them. Hated it. Hate them. Not for that very reason. I hate them because what they do is they distort markets during volatile times, and even worse, they distort markets during non-volatile times even worse. They make everybody feel so bulletproof, and this is so easy. As Rago says, I'm a professional dip buyer forever. That's what people think. And I keep telling you, and Don and I kick this back. One day you wake up and you get 1 day of systemic risk and you're like, I quit. You won't ever, you're going to realize like you can't ever take a day off in this business and think like this is an easy day. There is no easy day ever in this business. Even buying the dip is going to cost a lot of these people probably most of their life savings one day. It can't be that easy when this is always a tail risk event that's always out there all the time. So again, I just want to make you understand this unusually erratic trading action rattled investors, okay, especially because it occurred just over a year after the markets had rebounded from the biggest decline in more than 6 decades. So it actually occurred a year and a half after the housing crisis. So it's like adding in, it's like double the fear, deja vu, insult to injury. So the question is, what was the culprit for this? Where is the culprit around this? Okay. So let me bring this to you, and I'm going to bring a graphic in here if I may. Okay. Adding another graphic. I love high frequency trading. This is what it reminds me of, right? Large volumes of trade orders and large profits. No, it's not. It's little teeny profits that have to pyramid on each other and, piggyback. Captures trade opportunities within seconds, right? Executes trades in multiple markets simultaneously. The good news is it provides an automatic liquidity cushion. There's always a chance for you to get out or get in any trade as long as the boxes are dominating. So if you're out there going, I'm trading a stock with 60,000 shares all day, there ain't no HFT there. The HFTs only congregate, okay, en masse to things that have lots of liquidity and very tight spreads, high profile companies where there's very little slippage. They're not going to trade a stock with 25,000 shares. That's nonsense. They're going to trade a B of A, a Wells Fargo, an Apple. Those are dominated by HFTs, dominated by them. But I digress. Let's talk a little bit about what we call spoofing. What is, I know Don knows what it is. I know what it is. I know what Brandon knows what it is. I know Blake knows. I'm not sure Gianni knows what spoofing is. Let's talk about what is spoofing. Okay. What caused this bizarre behavior on that fateful flash crash day of May 10th, 2010? May 6th, pardon me. Okay. In a joint report released in September 2010, the SEC and the Commodity Futures Trading Commission, CFTC, pinned the blame on a single $4.1 billion program trade by one trader, Uno, at a Kansas City-based mutual fund company. Ladies and gentlemen, I cannot make this up. I can't. I'm not that creative. My daughter is. I'm not. One individual mutual fund trading company in Kansas City or Kansas, might have been in Overland Park. Okay, might be that famous one out there. Okay, but in April 2015, US authorities charged a London-based trader named Navinder Singh Sarao with market manipulation that contributed to the crash. Sarao was extradited to the US and he pleaded guilty to the charges. Sarao, now get this, people, Sarao allegedly used a tactic called spoofing. What's spoofing? Spoofing involves placing large volumes of fake orders in an asset or derivative. Sarao used the S&P E-mini 500 contract on the day of the flash crash. So that was his product of choice, the E-mini, right? It's basically placing large volumes of fake orders that get canceled just before they're filled. When such large-scale bogus orders show up in the order book, they give other traders the impression that there's greater buying opportunity or selling interest than there is in reality, which could influence their own trading decisions. For example, a spoofer may offer to sell a large number of shares in stock ABC at a price that's a little away from the current price. So when other sellers jump in on the action and the prices go lower, the spoofer quickly cancels his sell orders in ABCs. In ABC, and then he buys the stock instead. Just outright buys the stock. Okay. After then, the spoofer puts in a large number of buy orders to drive up the price of the ABC he just bought, right? After this occurs, the spoofer then sells his holdings of ABC, pocketing a tidy profit, and cancels the spurious buy orders, rinse and repeat. So the person is doing what? Okay, he's pretending he's making a market that never exists because he's not going to stand by that market. He's doing what's called backing away consistently. He's creating an illusion of of liquidity in a market of which there is none. So he's an agendized. He's putting in orders on both sides, head faking until he finally drives it in a direction and bails and leaves other people hanging. That's spoofing, people. And that's part in what the HFT is about. Most HFTs are now governed, managed by people. Okay, right? Wrong. Most HFTs are set on auto trade, which means when traders walk in the office in Greenwich or Singapore, New York, Chicago, okay, they press a button, they turn on the machine, and then they just let it go. So there's not a lot of people out there. During Sarao's regime, there were mainly people who were spoofing. Nowadays, yes, you can have machines do spoofing, but according to the market surveillance, it's far more difficult to surveil this, okay, and prove the case of it because machines are faster, they're more cryptic, they're more clever, but there is still spoofing out there. It's just less human influence and more computer influence. That spoofing is part of the systemic risk of the market, that you think order flow's there when it's not. And you think that there's short order flow when it could turn into a gamma squeeze and you get your head ripped apart. So again, many market watchers, they've been skeptical of the claim that one trader could have single-handedly caused a crash that wiped out close to $1 trillion of market value for US stocks within minutes. But whether Sarao's action actually caused the flash crash is a topic for another day for all of us. Meanwhile, there are some valid reasons why algorithmic HFT magnifies systemic risk. So let me put this out there for you. Let me talk about the amplification of systemic risk. Okay, I want to take this off, what's spoofing, and I want to talk about certain things that go along with this, such as what? Let's talk about intensifying, okay, volatility. Let's talk about intensifying volatility around HFTs. So HFTs have a dual role. You got to be aware of this while you're out there. First, there's a great deal of algorithmic HFT activity in present day markets. The estimate, and this is just an estimate, I'm just the messenger, so don't shoot me and kill me and make like I made it off the top of my head. It's not. Somewhere between 95 to 99% of all trades. I'm not talking about market cap. I'm not talking about all markets. Okay. I'm just talking about the stock market. Of all trades in the stock market, They're just done electronically. They're on an algorithmic loop. There's no people. The people are watching the algorithms doing all the work. It's like having a driverless car, okay? Tesla, that's what it's all about. So believe you me, it's out there, it's omnipresent, it's suffocating, and it's not going away. Algorithms can react instantaneously to market conditions. So as a result, during tumultuous markets, algorithms may greatly widen their bid-offer spreads to avoid being forced to take trading positions, or will temporarily stop trading altogether, which diminishes liquidity and exacerbates volatility. To my point, I've said this dozens of times in the past year. It's my term. I made it up. It's called tempo control. Algorithms have evolved. They're not just, deep learning or machine learning. They're generative. They think like people. They can actually adjust their order flow based upon slopes, based upon bid offer spreads, okay, based upon many things, okay? They have their own way. They can speed up the order flow. They can slow it down. They can cancel the order flow, or they can fire in multiple VWAP orders. So machines themselves have a ridiculous amount of power and control to move underlyings. How did that move $18? It's a machine. It's not people. It's a machine. They move fast and they're furious, okay? And if you try to take the other side of that trade, you get wiped, okay? And then all of a sudden, if the market, like right now, the E-mini is down 34. Picture this. What if that were down 234? So right now, it's all tempo controlled. We're still inside the curated, manipulated, rigged channel. We're in a rigged channel, people. We're still in it. We haven't come out of it yet. I keep warning all of you. I keep telling all of you need to temper your enthusiasm, you bears. We're still in that channel. Hasn't broken. But picture this. Let's just say we take out the bottom side of that channel and we take out 5,600. Fat Maribozu. MACD goes waterfall. What can an algo do? Cancel bids and drop it another 500. Can. Or it could lean into it and go, let me just throw in 10,000 contracts and shove it over 50 points. That they can do. They have the power to adjust. They can either perpetuate and amplify losses on the short side, or cancel bids on the long side and make it even worse because there ain't any liquidity. So they don't even have to push it over the edge. They can just stop liquidity and let it free fall and gap another 200. That's what I'm trying to tell you, people. Like, we're going to wake up one day and something bad's going to, I don't know when it is. I'm just dumb. I have no idea. I just know I'm going to look at my technicals. I'm going to go, oh, look, the monthlies, the weeklies, and the dailies are down at the same time. Oh, look, we're down 700. Hey, Blake. Blake is going to look at me going, yeah, been waiting that for 10 years. Kaufman's going to tell me what took it so long. It's going to happen eventually. It's just because that's the nature of dealing with machines. You think the machines are there to defend you. They are in a situation like this. When the actual slope defends, you're okay. It's when the slope stops defending is when you're screwed, you're done. I keep warning you this because the machines, they'll just go in and they'll wreck it for months. They'll put into a bear market for years if you let them. They have tempo control. It's all part of what's called intensifying volatility. If volatility intensifies, remember, they can lean into a short gamma squeeze. It's like, oh, we're up 100. Now we're up 200. It cuts both ways. The algos can drive it up and they can drive it down. It's two ways, people. Two ways, HFT. I want to remind you of that. And they can tempo control going, oh my God, it's coming down like it's a tsunami. They'll just cancel bids and we're down another 200. What are you going to do? You're going to cry about it? There's nobody there to buy. They can do that. They can be on either side, both sides, or one or the other. Remember that. That's systemic risk. Algos have that power. They can intensify the volatility or they can kill it. Today, they're killing it. Killed it. They killed it. It's down 70. The VIX is up. They kill the vol. Why? Because they're programmed to kill it in a configuration like this. You turn this upside down, we're down 500 today. The algos can kill it. The algos will do this when you break. We haven't broken yet. Just wait on it. When we break, the algos ain't going to defend. I keep warning you, all of you, this. They're not going to defend. They trade into momentum. They don't defend. And if they start canceling bids, it'll get ugly. The next part of the amplification, this is going to be an interesting 3-day program. I got plenty of firepower. It's what I call the ripple effect. The ripple effects. What's a ripple effect? And I'll close out on this today because I got a lot of stuff to do. Here's a ripple effect of an algo. And I love HFTs. Sure you do when you're making money, but when it goes against you, you're like, shut them down. Yeah, you're going to shut down what? You can't shut them down. They run the market. Given the increasing degree of integration between markets and asset classes in the global economy, a meltdown in a major market or asset class often ripples across to other markets. And asset classes is what's called a chain reaction. So for example, the US housing market crash once upon a time in 2008, it caused a global recession and a debt crisis because substantial holdings of US subprime paper were held not just by US banks, but also by European and other financial institutions around the world. Another example of a ripple effect is the detrimental impact of China's stock market crash, as well as the collapse in crude oil prices on global equities from August 2015 to January 2016. I'm going to tell you right now, I have no idea what that catalyst is. I'm going to defer it to Brandon and Blake are the resident economists at Theo. I'm going to lean on them. It ain't going to come from me because I am not an economist. I'm just a finance geek. I'm a numbers crunching guru. I'm going to leave it to these guys to figure it out. I don't know what's going to be the cost because I'll just listen to them and they'll speculate. But when it happens, it's going to be a ripple effect. And a ripple effect is like this. This is a ripple effect. Okay. The algos, the HFTs, when people say, how did this happen? It starts as an economic event and then it transitions into a market event. A high frequency trading is a market event. It is a market dynamic. It is not an economic dynamic. It has nothing to do with valuing things. So be aware of the effect of the ripple effect. The intensification of volatility automatically flows into a ripple effect. So you're looking at volatility contained. Look at it. It's contained. We're still in the V channel. The VIX still contained. It's all good. It's all good. Picture in Kaufman's head, because this is what Don's thinking. I can see it in his head. In his head, he's thinking to himself, how are we going to break this channel? I don't know. But if we do and we start gaining traction, I think the speed of the downside move is going to obliterate this market. By the time you wake up like, oh my God, I had some coffee. Oh my God, we're at 5,200. Can happen. I'm not saying it's going to happen. I just wouldn't bet against it. If you remove the HFT card, not likely to happen. You have HFT in there where computers have sped up everything, latency, ripple effect, intensification of volatility. They can tempo control. Woo, bring it on, baby. Because I'm short right now, loaded in a lot of stocks. I'm waiting. I'm waiting for them to blow out a lot of these stocks that are ridiculously overpriced. There are so many out there. It's ridiculous. Start with like Jeffries, JEF at 38 times earnings, Coke, Pepsi. Just wait till they get, when they start compressing the multiples, ooh, it's going to be fun. But for me, I'm going to wait on the HFT. I watch HFTs all along. Do I trade against them? I do not. Do I trade with them? Only. Am I an HFT trader? I'm not. I don't have the money. I don't have the resources. I don't have the knowledge. I just know one thing. I have enough like proficiency to understand what can happen systemically when these things go awry. And that's what worries me every day about trying to protect my money. I walk in, I see, oh, there it is. Market's up 12 consecutive. It's nonsense. Complete utter garbage. There's no fundamentals. It's all driven by Powell and a bunch of machines driving. I'm just waiting for the day when Powell has no impact and the machines, okay, you can't stop them. That's what I'm waiting for. On the other side, this will be interesting. But tomorrow, we're going to continue this discussion because there's other things afoot within the actual HFT sector in terms of the biggest risks of HFT. And I also want to get into, like collateral risks, not duress, but collateral risks. And then what things can be integrated, okay, to actually slow down the actual impact of HFTs to a degree where they won't hurt the market as much as they could, or they won't make the long side as profitable or overextended as it seems. That I'll get into. We're also going to talk about HFT strategies. What are HFT strategies? We'll get into that tomorrow. On that note, I'm going to turn this over to Dr. Rosenblum. Corey waits in the wings. This could have been a really, really detrimental day. But the way I look at it, I'm not going to steal Corey's thunder. Corey, this is the way I look at it. Until we actually break a crucial support level, 5,700, and take out an algo channel, Corey, I do not believe we're going to sell off at all. Corey, you got to show me. You can't talk. Show me you can break this with a Maribozu and break an RSI of 50. Then I will change my tune and come to the bearish side. What say you?
I am with you on the bull side. Different reasons, but same type of logic, seasonality, selection, and we're not breaking support. We had a shot to go down. All the things were down, and we're I wouldn't say we're up, but we're not down as much. So that's a bullish sign.